Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press *0. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Thank you, operator. Hi, everybody. Thanks for joining us for our monthly conference call. We're speaking to you from brand new office space here on the 18th floor, One University, and we look forward to having you maybe to an office visit at some future date. I'm joined today, as always, by David Burrows, our President and Chief Investment Strategist, as well as Jimmy Brennan, who is Head of Fixed Income Trading, Portfolio Manager as well. And what we always want to do is push on our commitment to transparency and update you on the most current themes we're observing and how that's manifesting itself in the portfolios. So, I'll turn it over to Dave now, and we'll discuss some of those more pertinent themes.
Great. Hey, folks. Thanks for taking the time today. What I thought I'd do just really quickly is take a rundown through the lenses that we use here at Barometer as to what's going on out there. And re-examine some of the key themes, and then talk about the positioning in the portfolios. As I think most of you know, we made a case now since end of 2012 that we are in a secular bull market for stocks, which is characterized by two things: earnings growth and multiple expansion, much like the period we saw between the period 1982 and 2000. And since then, there's been lots of discussion about the fact that there has been a lack of significant corrections, and the market has been fairly steady. Many people ask us, are we due for some kind of significant correction? Interestingly, last week while I was in the West, I think just about every meeting I did, I asked the question to the clients, who in the room is concerned about risk of a significant correction? And in each case, roughly 50% of the people in the room put their hands up. So, there obviously is caution. There obviously is some skepticism about markets as they stand. So let's take a look at it through our lenses. As you know, we have two basic sets of tools. The top-down tools we use to help us understand the macro environment look at whether money's getting put to work or not in specific asset classes. Our case is that in a healthy market, through a revaluation, the percentage of securities performing well should be rising as money gets put to work. And if we look at equity markets globally, in general, through the majority of world markets, we are seeing expanding breadth. Importantly to us, when we look geographically, the U.S. stock market, really since last fall, has seen very steady, slow improvement in the percentage of stocks performing well, today sitting around 60%. Which means that money is getting put to work in equities. It's not leaving. Second, at 62%, the field position is pretty good. If we look at the period of the 80s and 90s, the discrete cyclical rallies that took place during that period tended to top out at 75, 80, 90% of stocks participate. We're nowhere near that today. And despite some little wobbles here and there, we have seen no evidence whatsoever of any deterioration in breadth. The Canadian market, after lagging all the way through last year, breadth contracting from February 2014 through January 2015, turned higher in January, and here we are in May, and again, slow, steady improvement, sitting at 52%. So field position in both cases very strong. If we look globally, 46% of stocks globally are in long-term advances, so we're at midfield. And certainly there's almost nothing that is overowned and overpriced. From a market perspective, things are slowly improving. Now, there have been some pretty clear themes over the last just about a year. We had, after 12 years of a declining U.S. dollar, we had a blast-off last year, and the U.S. dollar rallied versus virtually all world currencies. And not unexpectedly, the things that tend to do well with a strong dollar led global markets, U.S. equities in particular. In the U.S., regional banks, healthcare, specifically pharma, biotech, consumer discretionary, some industrials like specialty chemicals perform quite well, and these are groups that we've been focused in. In periods of time when the U.S. dollar was weak, strong, it tended to be things like energy and materials, metals and mining, heavy equipment. Commodities tend to underperform, and of course they did last year. Now, that all being said, in the last 8 weeks, we've had a little pullback in the dollar. I think a lot of people felt that the rally got overdone as we came close to parity on the DXY. It's pulled back for about 6 weeks. But I want to make a point, when you look at the 1990s where the U.S. dollar rallied all the way through the decade, driven by a demand for U.S. stocks from around the world, there were several short pullbacks along the way. I mean, nothing goes straight higher. We'd all love to see things go up 1% a month, but we know what happens in bunches, and then you get retracements, either in time or in price. And the U.S. dollar's pulled back a little bit, but very clear upward price trajectory. When we look at the Canadian dollar versus U.S. dollar, we would also point out continues to be a very clear downward trajectory. Not to say you can't have short-term bounces, which of course we have. Canadian dollar's bounced from 77 to 80, well now sitting at 81, bounced as high as 83, and then ran into some resistance. When we look at the sectors, fourth and first quarter, they've all pulled back a little in the last 6 or 8 weeks. And the sectors that got most badly beaten through the fall of last year and early this year, had a little bit of a bounce. So the obvious question is there some kind of significant rotation taking place? We've been making the case for the last few weeks that no, this looks more like a time correction. And when you look at the commodities chart, for instance, the basket of commodities, commodity prices have steadily dripped lower over the last 18 months and certainly have bounced over the last 6 weeks, but underneath declining moving averages, really nothing more than retracement. And when you put in the bigger picture, commodities really went through their revaluation phase between 2000 and 2012, relatively underperformed for 18 months and have been absolute negative performance over the last 16 months. And this little bounce is barely a wiggle on that long-term chart. So to us, the key themes really continue to be in place. Consumer discretionary, healthcare in particular, technology in particular, and financials. What we are seeing a change in is the treasury market. Government fixed income, sovereign debt. Whether we look at treasuries or we look at funds, there has been a significant and sharp pullback in price, meaning yields have gone higher. They made a rally attempt in February, beginning of March, which failed at a lower high. They made a lower low, and it does look as though we have seen a fairly significant watershed shift there. Now, that means that the things that did well early in the year that were interest rate proxies supported by low rates, REITs, investment-grade corporate debt, preferred shares, utilities, none of those are doing particularly well, and in fact look quite technically broken. These are groups that we've been trying to avoid. What does do well with rising rates, of course, is financials. And if you're taking deposits short and lending long and making a spread on the difference, certainly that's a good thing if rates start to work higher. And clearly investors agree, because if you look at the chart of the U.S. banks, and you can look at KBE as the ETF as an example, a year of, say, trading sideways in the last 2 weeks have broken out to new 52-week highs. The Wall Street firms like Morgan Stanley, JP Morgan, Goldman Sachs, also breaking out to new highs. And so one thing we take away from that is that, clearly in our work, from a risk-reward standpoint, breadth has been improving. We are always looking for those securities most likely to give us good dividend increases. And with dividend payouts, less than half their historical average held back by the Fed, obviously lots of room there. Our view has been with interest rates at a 100-year low, doesn't make sense really to push on that trade. We'd prefer to focus on the things that do well as rates reverse, and it looks as though financials are that bucket. So this is our biggest weight really across all of our portfolios, and looking forward, our goal is to get to what will work next, probably not what's worked over the last number of years. So we made the case for some time that the bull market in the production of energy is the game changer in the U.S. The price of oil topped out last summer at $106 a barrel. Volumes continue to grow, and the price pulled back to $45. There's two things you can do with that. One, you can make the bet that prices are going back to 100. We have not been prepared to make that bet for a number of reasons. We focused on the things that benefit from structurally lower energy prices, which include the consumer. as the biggest beneficiary, 72% of the U.S. economy. Healthcare, which is the biggest domestically focused industry in the U.S. And then technology, because as corporations in the U.S. are improving, they are spending some money on capital spending. Technology is particularly interesting to us because historically we look at this as a high-growth sector, but when you look at the source of dividends in the S&P 500 today, interestingly, the largest contributor to dividends and dividend growth in the S&P is the technology sector. So these are big cash flow generators. They have relatively low dividend payouts. They have significant cash on balance sheets. They are not capital-intensive businesses, so they've got a couple things they can do. They can buy back shares, which they are doing. They can make mergers or acquisitions, which they are doing, or they can raise dividends, which they are doing, all three of which we think are good for us as investors. Now, we take the other side of the coin, the energy trade, and certainly there's been a bounce in oil prices, not insignificant, and some improvement. If you look at E&P companies or exploration and production companies, they've rallied over the last 6 weeks. But remember, there's two things we look for in our security selection model. One is prices getting better, and second, fundamental characteristics that point to something changing for the better. In our main mandate, the income mandate, our job is to find rising dividend streams or improving credit. In both cases, they're deteriorating in that sector. Estimates continue to be cut. And when we look at valuations for exploration and production companies, it looks to us like they're trading at about 9.5 times cash flow. Long-term average is 6.5 times cash flow. So trading at roughly a 50% premium to the last 25 years, which would put them trading at prices that would indicate oil at $95, which is a long way from here. So with very, very high years and thousands of uncompleted wells yet to come on, it does not make sense to us that we are likely to see significant dividend increases from here. So we think this is retracement, and we've stayed focused in those other core leadership groups. So our job is to follow our process. We are finding lots of opportunities. The income mandate is a flexible mandate that lets us deal with different types of environments, and in a world where the growth is getting a little better or there's higher rates, the job is to focus on things that can do well in that environment. So as we sit today, that high income mandate, which today we now call the tactical income strategy, is 100% equities. From an asset allocation standpoint, that is where money is getting put to work. Field position is good. When we look geographically, exposure is dominated with U.S. investments. Roughly 6% of the assets in the fund would be in the U.S., the balance in Canada. From a sector makeup, financials are our biggest weight by a lot at 35%, specifically U.S.-based financials, regional banks, and Wall Street firms would be the biggest makeup. That's about 35-36% of the portfolio. Then behind that, we have consumer discretionary, healthcare, and technology. Lots of targets in those groups where things are good and getting better, and the likelihood of increased dividend yield. Dividends are growing nicely in the S&P. We've had over 50% of the holdings in the income portfolio give us dividend increases so far this year. And while dividend payouts are higher than they were 2 years ago when they hit a low of 26%, we're still only 34%, so way below that 50% long-term average payout. And cash positions in corporations continue to hit new highs. So we compare that to the bond market, 10-year Treasury trading at about a 50 times earnings multiple, which, arguably is about where stocks were in 2000 before they made no returns for 12 years. We think risk-reward is better in equities. Since 1986, the best equity bucket to focus in was dividend growth. In the TSX, it averaged about a 12% return over that period, and interestingly, with less volatility than virtually any other bucket. Now, we would say that things are not equal today. Long-run average was the dividend yields came in about 300 basis points below a Treasury yield, and that discounted the fact that you would get dividend growth over time. Today, in the S&P, you're getting a 20 to 30 basis point premium cash flow or yield, plus dividend growth. So we're very comfortable with the positioning that we have today. When we look at the most open mandate that we have, our global macro pool, which we express using ETFs, we have a very similar makeup. U.S. is our biggest weight, focused in those 4 key sectors, along with some mid-cap exposure. We actually are short emerging market debt, which gets hurt by a stronger dollar, and some energy. The equity pool is fully invested. It is roughly 65% U.S. stocks. Important to note that in that pool we do not have a dividend mandate, so there are many growth-oriented companies in a world where growth is scarce and hard to come by, which we can get exposure to there. And in the long-short pool, similarly, about 65% in U.S. stocks. I'm going to get Paul to talk a little bit about the tactical balance pool. Sorry, Jimmy, to talk a little bit about the tactical balance pool. But before I do that, I just want to touch on this. The various pools and funds are having a real good year to start the year. The equity strategy is up about 9% year to date. Long short's up about 9%, 8.66% year to date against the TSX and S&P both up about 3%. The ETF pool is up about 6%. The balance pool is up about 5%. We have had questions about the income strategy. The fact is it is a little bit behind our benchmark so far year to date. And I want to touch on this before we move on, because surely if you are a tactical mandate and if your sector weights don't tend to line up with the index's weight, because we do focus on what we consider to be market leadership, it means that we have a low correlation to a benchmark. When you have a low correlation and you have retracement or pullback in the stuff that's been working short term and a bounce in the stuff that hasn't, you should expect some different returns. So we went back and we looked at inception to today, 2000 to 2015, and found that there are 7 periods where for a period of several months the income portfolio returns were out of line with the market or behind the benchmark. And certainly Nick Hamilton can give you a copy of this slide, but the upshot is, in every case, 1 year out, there was significant outperformance as leadership reestablished. 2 years out, much more significant outperformance, and 3 years out, very significant outperformance. To put it in magnitude, the average period of underperformance was about 3.5% over a period of months. The subsequent average 12-month absolute outperformance of the benchmark was 6%. 24 months out, there was an absolute 11% outperformance versus benchmark, and 36 months out, an absolute 21% outperformance. What that means is, when we've seen pullbacks like this has been a great entry point. And based on the work that I see, and based on the fact that the financials have just started to break out of a 1-year base, our market that took place with financials breaking out to new highs, I think this is an excellent point to be committing capital in general to equities. And in our strategy, I think this is even a more optimal time. So I'm quite bullish, and I think that the rest of the summer sort of sets up well. I want to pass it over to Jimmy just to talk about balanced mandate for a moment, and maybe touch on the corporate debt market, specifically high yield.
Sure. Hi there, Jimmy Brennan here. Thank you for your time. I'll just expand ever so briefly on a couple of earlier points David made. In February, there was a total of $2.8 trillion of negative yielding debt outstanding, much of it sovereign and supra stuff. Central banks are printing money to buy bonds and stuff to try and kickstart these economies. And in effect, these central banks have made fixed income an unappealing asset class by any measure. So in April, the DEX Canadian Universe Bond Index returned minus 2.1%. Over that same period, all U.S. high yield returned minus 20 basis points. So what that means is 190 or 1.9% of that return was attributed by government debt. So these are large positions, And many balanced funds that hold generic or index-like collections of debt would be larger, but they have no choice but to hold this type of stuff. Here at Barometer, the balanced fund mandates totaled $90 million, so right now we're at 25% debt, which is the minimum amount that we'll hold. That's $22.5 million worth of bonds and debentures. These have been very stable securities. In April, they performed very well. Our direct cash bonds, which we looked at, the stock was yielding 8.30, and the bonds have an 8 1/8 coupon. They moved from 102.5 to 104 3/4. We bought some Davis and Henderson 5% convertibles. They shot up from par where we bought them to 107. We sold and bought the Davis and Henderson stock then at a $7 discount. So we're very tactical in our mandate, and we stick to it. And this size enhances our flexibility.
Yeah, great. So let me kind of wrap up. Look, the Nasdaq is making its new high for the first time in 15 years. You know, we spent a lot of time talking about the fact when you exceed the highs from the previous bull market, you're in the early stages of a new bull market. In 2000, the top 10 stocks in the Nasdaq 100 traded at 100 times earnings. Today, the top 10 stocks are trading at 16 times earnings. In the S&P, the top 50 companies traded at 27 times earnings in 2000. They're 16 times earnings today. We have a very reasonably valued market, especially given the backdrop of fixed income. So our breadth work points to higher equity allocations for investors. Dividend yield and dividend growth both look very attractive. We know there is cash starting to get put to work in equities. We know there's lots of things to worry about. That's why we're in a bull market. And going back to that statistic I cited at the beginning of the call, where roughly 50% of the people we've been talking to are concerned about a correction. If you look at the Investors Intelligence numbers, today, roughly 47% of U.S. investors don't know which way things are going. They're confused. That's the highest undecided reading in the last 10 years. So this is not the way bull markets come to an end. We think that the contrarian view is that things go higher from here, and there's all the evidence in the world that supports it. We are structured for that. Our exposure to financials puts us in a great spot. If we are into a slightly better economic data, index of economic surprise in the U.S. just started to turn higher. Very good housing numbers this week, and some very good auto numbers cited today. So there is certainly some value in the comment that cold weather had an impact through the winter and maybe cooled things down a little bit. Even the U.S. Bureau of Economic Data is looking at revising the methodology used to calculate first quarter GDP, stating that the seasonality actually has a bigger impact. So we think things look pretty good, and there is cash to get put to work. So I want to pass it back to Nick, but I guess the last thing I want to say is this. In a bear market, the hardest thing to be is a good seller, because people are convinced that they don't want to sell things at losses. When you get into a bull market, the hardest thing to do is to be a good holder. And we'd all love to see things go up 1% a month, but the reality is returns come in bunches, and then things go to sleep for a while. And it's easy to get bored, and it's easy to decide maybe I should be doing something different. But when I look at the consumer stocks, and when I look at the healthcare stocks, and the fact they've gone sideways for 6 or 8 weeks, that is not a reason to be a seller. And it looks to us as though this leadership is intact, and I'm very happy with the way we're positioned. So I want to pass it back to Nick. I want to thank everybody for taking the time to listen today. Hopefully this is useful, and certainly we're happy to answer questions that you may have.
Great. Thanks, Dave. Thanks, Jimmy. Just to summarize quickly, I mean, we recognize that our business is built on the notion of, durable relationships, and it's all about, ongoing communication of our strategy, our views. We are a very uncorrelated manager. We do pay attention to market leadership, and there can be periods of rotation that occur where, as David said, things go to sleep for a little while. I would say, and I would highlight the video update that we put out recently, David put out recently, as a very useful tool to pass on and to use with your clients to highlight the current context of the markets and our positioning and the performance. as it pertains to the high income strategy, as was mentioned, we have some very powerful slides that I think, and Dave echoes, a very attractive entry point because given that our strategy is unique and uncorrelated, there can be rare periods where we appear out of favor, but those have always turned out to be very positive entry points. I think it's also worth mentioning that our other strategies, very uncorrelated, doing very well and worth noting, and very different from what's available in the investment landscape. So we're happy to have discussions on the balanced, the long short, the global macro. As you probably noticed, some of the names have changed, so you saw that communication from us. We're happy to report that both the balance and long short strategy have had their risk ratings reduced in light of additional flexibility to allow them to navigate within the respective spaces. So